All right, in today's video, we're going to cover a lot of things. Actually, I'm going to talk about some trades we've been looking at in corn, cattle, crude oil, natural gas. Natural gas is an interesting one. Hang around for that. But also I want to talk about the upcoming new Micro Treasuries. I mentioned them in a podcast a couple of weeks ago, I think. I'll have a link to that below. I think it was a podcast, not the video. Anyway, whatever. But we'll have a look at that because some really interesting stuff. And a little, for those of you that like data, like me, data nerds out there, I've got a little data gift for you as well. Most of this stuff is normally what we cover on our private group chat, but I'm making it public because it's kind of a mix-up of different data and different things that we're looking at. So it should be a lot of fun. All right. First up, corn. This is one we've looked at a little bit for a little while now. What we look at for those that are new to what we're doing, we're trading in spreads here. We're trading in commodity spreads. This one is trading December versus March. Commodity spreads sound more complicated than they are. They're really not that complicated. We're trading, instead of taking a directional position in a commodity, we're trading the price difference between different delivery months for that particular commodity. Makes sense? So in this particular instance, we're looking at December, March. And those of you that have done my advanced spread course know that we look at these markets through the eyes of seasonal data. We have a database that we search around for and look for these kind of trades. And that's where this chart on the right has come from. In this particular instance, we're looking at December versus March. It's been an interesting trade. For those that are in it, there is not much left in it, I don't think. If you're looking to get out, it would be pretty soon. Within a couple of weeks, I suspect we'll come back to it and have a good look, possibly from the point of view of a bull spread. That would be most likely if we see this corn market drift off a little bit. But at the moment, it's kind of doing nothing. So that spread's going to continue to do nothing, that being the case. Next up, cattle. I think this is still a good trade, but only for the next couple of weeks. In this particular trade, it's a bearish trade. It's a bear spread, as they call it. Short October, long December, and I think it has a bit more guts going in the for the next couple of weeks. Those of you that haven't seen these charts on the right, these show these show the current spread price between the two contracts, but also the seasonal averages over 5 years and 15 years. So you can see the trend in August to be quite strong for both in the last 5 years and the last 15 years. And that's what, being in this trade would be betting on. It's going to be choppy for the next couple of weeks, but get worse in September. So I'd be well out by then. But I think it still has some legs to run, particularly if we see some good downside in cattle futures over the next couple of weeks. Crude oil, we've spoken about this one before, and man, this one has really gone very well. Choppy, yes. Again, it's a bear spread, which means we're in this particular instance we're selling December, buying January. But those two sell-offs you can see on the right here. Can you see that one? This is the spread price between the two. And over on the left, I've got the two individual contracts. I mean, by themselves, they kind of look much the same, don't they? December looks the same as January, but look at the spread price between them. They do move. The price differences between the two delivery months move quite a bit and have done, particularly in the last week, which has been a great move, better than the move in the underlying itself. So with that, however, our little seasonal pattern, again, I'm showing the same thing here, but on the right, I've got the seasonal pattern overlaid. There's not a heck of a lot of time to keep in this trade. You probably look at that most recent move. This one here is a good opportunity to get out if you have been short. That's just my opinion. Again, not advice, but just my opinion. But it's been a pretty good trade. It did take a little while to come good. The seasonal trend started in May, and those moves have only happened in July. So The timing hasn't been great, but the moves has been fantastic. So, but it is time to probably pull out of that one. Definitely this month, but sooner rather than later, I would think. Natural gas is a really interesting one. Again, check it out. As I said before, this is the crude oil. These two, the December and the January contracts, kind of look the same, right? Try and pick them apart. They kind of look the same. We can say the same with our natural gas contracts. Here we're looking at a bear spread in January versus February, months right next to each other, obviously. Again, these charts look the bloody same, don't they? You can't kind of pick them apart unless you're looking at the scale, and even then it's not much difference anyway. But the spread price does move. Now, we've been looking at this particular trade as bearish, as a bearish potential, and you can see what's happened in the underlying has been anything but bearish. But what's been interesting, and the reason I want to bring it up, is because it shows us one of the advantages of trading spreads as opposed to trading the outright positions. Trading outrights, particularly natural gas, can be a mad market to trade. And clearly, if we took on a bearish position here, we wouldn't have done so well. We would have been stopped out, got in again, stopped out, got in again, stopped out, got in. Whereas the spread, on the other hand, I've marked out 1, 2, and 3 here to show you what the spread has done at these particular highs. As the markets rallied, the spread hasn't really got any worse. So even if you got in at a good price in a short position here, expecting this downside that we'd been looking at, then you're never going to be offside too much. You play the waiting game, sure, but that's the worst it's ever been. You just play the waiting game, which happens in natural gas spreads. As I said, natural gas trading outrights can be pretty wild. You would never, as a new trader, you would never get into trading natural gas outrights. A bit like crude oil. And we'll look at a crude oil trade. We looked at a crude oil trade a minute ago, and we keep looking at crude oil because it's a good spread market to trade. But natural gas also can be a very, by comparison, a real gentleman's market to trade in spreads. I don't know if that's the right term, but it can certainly be far more subdued, far more capital friendly, if you like. Particularly if you're new to trading spreads, it's a far better option than trading the outrights. But where are we up to next? Natural gas. There's the seasonal pattern for it. So this is a good one to show you, actually. So again, with this 1, 2, 3 point, this is what the spread looks like on the right. The black line is essentially the same as this candlestick chart here. Shows you that 1, 2, 3 point in the spread. But there's the seasonal trend, which still I think has a lot of legs to go. Again, January, February, we're a long way off expiration. It gets a bit crazier closer to expiration. It's not something we'd normally look at, but certainly it's not going to be a bad decision to be holding that trade, holding a bearish position, even though that underlying market has been in quite a bull trend. Never say never, of course, but it hasn't. Holding a bear position hasn't been a bad decision. And may well come good even with a moderate correction in the underlying market. What else are we looking at? Soybeans. Okay. So we spoke about this last week on our private chat group. If you're not familiar with, this is a butterfly spread, which is a spread of a spread. If we think about a spread contract, or a spread strategy, I should say. A spread is we're trading 1 month versus the other. So natural gas trading January versus Feb. Crude oil trading December versus January. Okay, we're trading the spread between those two contract prices, right? That's pretty simple. With a butterfly, people get confused with these two, but again, they're not really that complex. A butterfly is a spread of a spread between two spreads, I should say. In this instance, we're looking at March, May, and July. So the first spread we're looking at is March versus May, and then the second spread is May versus July. And a butterfly spread is, in this particular instance, would be a bearish strategy. So it's something that will have gained as the market has fallen. And our stats show that, over 5 and 15 years, this strategy, long way to expiration from now. It's now August. This is the first contract expires next March. This strategy has a very good seasonal pattern that lasts all the way from July through to September, and then further on October through to the end of the year. So it's something we have been looking at, again, in a weirdly ironic way. It's a good way to dip your toe in these kind of markets. Trading soybeans outright can be crazy, just like trading natural gas can be crazy. I've had swings trading soybeans outright of $50,000 in a single session, and it's pretty crazy. It can be pretty crazy. You're never going to see that trading. Unless you're trading massively, ridiculously large volume, you're never going to see that trading something like a butterfly spread, particularly with such a long time to expiration. These are sleepy kind of spreads, and they're a good way of getting into commodities trading because it's not capital intensive. The margin deposits are relatively small. I think this one was a $500 deposit. I think $525. Margin deposit to trade this one. So, and they, in some ways, can mimic what the underlying is doing. So, if we're bearish on the market, we take on a bearish style spread, a bear spread, or a short butterfly, or that type of thing. And you can see that actually because you can see the market falling here. You can see where I'm drawing there on the left-hand chart, and that the value of that butterfly rallying, which is what it's done over the last few weeks. The reason it does that is because the near contracts perform stronger in whatever direction than the far contracts. So it is a directional type position. But we have more videos of that on the MasterClass Trader site. I'll give you the link at the end. We have more videos about butterflies, but I just wanted to go through that one. I still think it's a good looking trade. It's never going to shoot the lights out in what it's going to make, and it's unlikely to risk much as well. So I still think that's a really good trade. Probably selling into strength would be a good one, but and there's very specific techniques I'm getting into butterfly spreads and spreads generally, but we cover that in the course. We cover that in other videos. One last thing I want to look at. Where's my mouse? There we go. Micro Treasuries are a week away from being launched. So if you haven't, I think I've done a podcast on that. Check out the podcast, link below. Micro Treasuries, they're different from the other micro futures contracts. And if you're not familiar with those, essentially a micro futures contract is a futures contract, but based on a smaller amount of underlying security. So the micro contracts in foreign exchange, in crude oil, in things like the S&P, the Russell, have been exceptionally popular. And hopefully, if it comes out the same with these micro treasuries, it will change the way we trade treasury markets. What the CME is coming out with is a 2-year, 5-year, 10-year, and 30-year micro futures. It's a bit different from the other ones, though. The other contracts, so the micro crude or the S&P, are 1/10 the size of the regular contract. These micro treasuries are priced differently. Now, if you've ever looked at treasuries and looked at the way they've been priced, and they're in 30 seconds, or the options are in 64ths, or the 5-year notes are in half of a 32nd, but not a 64th, it's half of a 32nd. It's confusing, it's stupid, and I still don't know why they are in fractions, but they are. That's, anyway. These micro treasuries, they're coming out priced in yield, not in price. So that whole thing where you say, oh, price is inverse to yield and all that stuff, we don't have to worry about it here because they're priced differently. They're also based on slightly different securities than the other treasury futures. Let me call them regular futures. So the regular 5s, 10s, 30s, or ultras and whatever, they're priced on different securities, so they're going to behave a little bit differently. But they'll be a heck of a lot easier to understand. Now, I spoke with someone at the exchange, and found out a few extra things that's not on their website about these markets. And of interest to us as spread traders, there will be a spread market between these 4 contracts. Bit like those of you that have traded treasury spreads, familiar with the knob or the bob or whatever, there will be spreads between these. Okay, and there will be margin offsets for it. They haven't published what the margin offsets are yet, because they don't know what they are yet, or that's what they said anyway. Also, there'll be no exchange spreads between the regular contracts and these micros. Okay, so there's no spread market as such. You can still spread it, of course, and there will be margin offset, but there's no spread market as such. So you'd have to have a platform that builds spreads around that. I think there'll be a good trade there between, say, the 10-year note, the ultra note, and these micro 10s. I think that something like that, or the ultra bond versus the 30-year yield, micro yield. I think there'd be some good spreading potential there. I think we have to wait till they start trading before we see what that's going to look like. And the big unknown is going to be what the market makers do. So if there's enough market in there, like there is the Micro Crude, the recently launched Micro Crude, then we'll be happy. There'll be enough to do. One last thing, if you're a bit of a data nerd like me and you like playing in big Excel spreadsheets, which are all a lot of fun, I've put together the complete history of the 2s, 5s, 10s, and 30 yields. Obviously, we have no synthetic prices for these securities because they haven't started trading yet. But what we do have is the historical pricing for, or what I put together in a spreadsheet, which I will give to you for nothing, is every single day back in time for the 2-year, the 5-year, the 10-year, and the 30-year. Let me just read. It goes back to 1962 for the 5s and the 10s, 1962 daily data. And 2 years goes back to 1976, and the 30-year came out a year later. So I've got a spreadsheet that has a few statistics and charts and all that kind of stuff that I've put together, which if you look on the Tradarian site, I'll give you a link in the next page, or link below, whatever. You can either shoot me an email, or the link to the data will be there. But if it's not there, shoot me an email and I'll send it to you. But check it out. That's the data from all time back to 1962. I don't think that you can do much with that. And unfortunately, I don't have open, high, low, close data. The best I could get was daily settlement prices for these securities, these benchmark, essentially 2, 5, 10, and 30-year securities. So that we're not going to be able to work out things like average true range. You can work out rate of change and give you some idea of volatility. But I think what'll be interesting is to play around, say, with a 2 and 10-year spread, or a 5 and 30-year spread, or a 10 and 30, the equivalent of the knob or whatever, and compare that to, say, the 10-year futures. If you can overlay that, but I won't have that data on that spreadsheet. I'll just have this note data. But I think that'll be the interesting thing, is to watch how these on the run securities, as they're called, will trade versus the futures. I think you'll get that out of it. But anyway, someone smarter than me will get more out of it than that. But it's all for you to download for free if you like data. I like data. So that's Micro Treasuries. I'm damn sure we're going to have a whole lot more on these when they come out, when they start trading. We're going to be looking at some spread trades, some scalps, and some yield curve plays and that kind of thing. So it'll be really interesting. Very excited. Very looking forward to these contracts coming out. And as I said, if you're a data nerd like me, then download that spreadsheet and see what you come up with. Let me know what you come up with too. It'll be interesting. As I said, some closing credits. Okay, so there's a couple of things you can do. If you've not subscribed to this video thing on the YouTube thing, please do so and click the little bell, because that's what we all do now. Check out my site, MasterClassTrader.com. We have an advanced spread trading course there, which teaches you all about that seasonal stuff we were talking about. And there's also a Dom Bootcamp, which will teach you a lot about the scalping styles too, and treasury markets and things. So a couple of courses there for you to have a look at. Click on the button that says specials, because guess what, there are specials there. Who would have guessed? Also, my site tradearian.com will have links to other stuff like the podcasts and the data download sheet and stuff like that. So there's three things there for you to do. Anyway, until we come back, I think probably the next one I've got on my list as we're going to look at gold and silver, a little bit of commitment of traders at some stage, and we're going to get back to those micro treasuries as well. So until then, party on.